when they cover that much short on the commercial side, that's pretty eye-opening.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics on a Monday morning, as once again, silver rising a little bit, which makes it extra exciting and special to have David Morgan, possibly the world's top expert on silver, join me to dig into the amazing things going on in this recent rally. I don't know if there's anyone more qualified to speak to what's going on. So, David, pleasure to have you on here today. How are you doing, my friend?
Well, I'm doing well. Thanks for the big introduction. I hope I can live up to it. But anyway, let's go ahead and get started.
Yeah, well, it's fascinating times. We've seen silver get pretty thoroughly pummeled for the last 8 years, a rally in 2016, which got snuffed out. So maybe just to start, I'd be curious your take on what we've seen over the last 2 months. Silver now over $17, and what are you seeing and what are you expecting at this point?
Yeah, well, I think going back just a few months or 2 months, as you asked, if you check any of the interviews I did up, 3-4 months before that time frame, I was very consistent that gold had to lead, gold had to break 1350, and until that happened, really nothing was going to happen. And of course, it took place, and I was asked by, I guess, Kitco to do an interview and several other places, just kind of to verify what I'd been saying for so long. And so now here we are. So now it's $17 silver. There's a lot of resistance at 17. I mean, silver breaking through 17 and getting to, let's say, there's no magic number, but let's say 17 and a half or 18 is about as significant as gold getting through the 1350 level, in my view. That's my opinion, because there's a lot of resistance at that level. It's not a 6-year resistance level like it was for gold, but silver is a different dynamic, trades differently. It's far more volatile, has much higher beta. And it's more, let's say, looked at on a short-term basis, if that makes sense, meaning that the data of a year is as significant in silver as data for maybe 3 years in gold. And I don't want to go into that's an opinion. It's not, can't be proven, so I'm going to state it that way. So I would love to see silver jump into the 18, 19 level here. And that would not only confirm the gold move, which is absolutely underway. I don't need silver to confirm it, but I want to see silver confirm it. It's sort of like the Dow theory. You want to see the industrials confirmed by the transportations. And it's very similar in the metals. Platinum's starting to move a little bit, which is good. Palladium, of course, has led the way, and no one pays attention to either the other white metals very much. But I'm convinced the bull trend is here. I think it's going to take more work for silver to get fully on board than some of us silver bulls might want. In other words, to get that ratio into the 70s even, I think it's going to take a little more work than, again, some of us would like to see.
So would you say that so far the main thing driving silver would be just the rise in gold more so than any specific factors to silver?
Partly, I'd say, a month ago, yes. And as of, 29 days ago, I'm trying to be funny, somewhat no, because what took place was the hedge funds that are pretty savvy saw the run in the gold market. The ratio is at like 95, 94, 93 to 1. Pretty easy trade to make, to either swap out or just add to a position or start a new position, where you could either go short gold, long silver, or just go long silver, or spread the trade or whatever. There's several ways to approach it. Regardless of that, it was like silver can't stay here forever. It's too small a market. And just them, not even all, but a few, thinking similar thoughts drove the market to like whatever it was, 95 to 1, 85 to 1, very, very rapidly. And that's a good sign. So far, every time you look at this extreme ratio, talking about the 100 to 1 or close to the 100 to 1 ratio, never stays there for months. It's a spike. It's there for a short time. So that was another clue that we were getting to the bottom of the silver market. But if you're long silver or want to be long, or you're long from a much higher price in the physical market, Every day seems like forever. The week seems like a month, and the month seems like a year type of thing. But once it does turn, which it has, it can, make up time very rapidly. Again, I think it's going to take a little more work than we might want, but nonetheless, it will.
Yeah, it's interesting you mentioned the ratio there, because actually one of the bullion shops I talk with, they mentioned one of the main trades they've been doing. They offer a gold to silver swap, and a lot of customers have been swapping gold for silver. I don't know that I've come across anyone in the precious metals field that is really advocating swapping silver for gold. So again, it's interesting, we have the paper trading, but again, in terms of physical metals being purchased or traded or swapped, it sure seems like at some point there's a mismatch, and that there's more demand out there now for silver in terms of physical than gold. Obviously, that gets skewed with central banks who are purchasing gold as well, but will be interesting, because I agree, as we see gold continue to rise. Interesting how no one's talked about silver for a couple of years. And quickly in the last month or two, it's like we see it in the media again, which obviously has some potential, the price continues to rise, to draw in more of the mainstream investor.
Exactly. I mean, silver is actually more hard to obtain than gold in many jurisdictions. If you're in North America, you're going to say, I'm full of it. But in Europe, you've got VAT, value added tax, that's substantial on silver. It doesn't exist on gold in most cases. Asia is practically non-existent as far as buying. So if you go anywhere in the world, I'm pretty world traveled, and I verified this. Not in every single country. I've not been to every single country, but I have been through South America, Mexico, Central America, Asia, part of Asia. Anyway, the point is that in most jurisdictions, you can walk into a bank, not always in this country, but and obtain gold. In other words, it's very simple in most places to just walk in with the cash of the country you're in and buy gold. To be able to do that with silver is very difficult in almost all places except like Canada and the United States. Even in Mexico, which is a huge producer, Peru, which is a huge producer, Argentina, which is a huge producer. I tried for a whole day and a half, basically, in Argentina. And even though they have these little postcards out there at the teller's window that you can buy gold or silver, it's pretty easy to get the gold. It's pretty hard to get the silver. So the point I'm making is that if silver was as easy to obtain as gold, didn't have a VAT that was kind of prohibitive to buy silver versus gold, you might have a much higher demand on the physical market than you presently have. And I think there's a reason for that, but that gets into the aluminum hat business, which I'm not really fond of going that direction, but you can draw your own conclusion on what I said. Fact is, it's more difficult to buy silver in almost all locations than it is gold.
Yeah, it's interesting you mentioned that. I remember when I was back on the trading floor, noticing once I got into gold and silver, how you talk about a hedge fund, mutual fund, bond fund, and it seems natural. It's like, all right, just call my broker and I'm in, versus gold and silver. It's like, well, how do I actually buy it? It's this black box. Although what's interesting is that it appears as if someone has figured out how to buy a rather sizable amount. As you know, Ted Butler and Aleister McLeod, they had a back and forth on the details of who might be buying a lot. Although, perhaps what stuck out to me was that here's two people who spent a large amount of time studying these COT reports that are both coming to the same conclusion, that there is a large buyer, regardless of whether it's China or JP Morgan. Along those lines, we do see 153 million ounces in JP Morgan's COMEX account. Perhaps even more stunning than that, I've seen, according to Bloomberg, we're now up to about 80 million ounces being added to the silver ETFs like SLV and the other ones. Kind of funny to me that Deutsche Bank has a silver ETF. But, I mean, you're really gambling there a little bit, but it seems like someone's buying a large amount of silver. Curious your thoughts on that.
Yeah, well, there are. The whole movement here in the gold market and spilling over in the silver market has been institutional buying. The retail sales have been lousy. In fact, a lot of retail investors have been selling back their gold, not too much on the silver side, but on the gold side, because they're back to, 1,500. No, I'm even. I bought at 1,500. I'm back to 50. Thank goodness I'm out of that doggone gold market.
Right.
And the reason you can verify that, say, well, David, just look at the spreads. The spreads are minimal. The spreads are very, very low when there is a very loose market or when there's plenty of supply. When supply is ample, the spreads are very, very low. When the supply is extremely tight, that's when the spreads widen. I mean, back when, 2008 crisis, when there wasn't any retail silver available, the spread was like 30%,
Right.
but now, of course, the spreads are very, very low on both the metals. But so there's that. And then going back to, it's funny you brought this up. I'm looking at my other screen, folks, so I'm diverting my eyes. But this depository thing you mentioned. So it's large buyers, and it's going primarily to the ETF. I mean, if it goes to the iShares, which is the SLV, this hasn't changed much in the last week, but there's 33 million ounces that have been bought in the last month. And you look at the ETF securities, which is SIVR primarily, it's almost 15 million ounces. So right there, you've got almost 50 million ounces over the last month of physical. Now, is this physical? I'd argue, yes, it is. Is it physical like you and I going to touch it and put it in our backyard? It isn't. It goes into the vault, but it's still physical movement. And then, as you said, Sprott, 1.4 million ounces. And then, as we both tongue in cheek, and I don't know why, maybe silver will save Deutsche Bank from going zero, but they picked up 8 million ounces in the last month. And I mean, I have to say this because I hope no one takes this seriously. I have to caveat it before and after, but if silver goes to 5,000 an ounce, that 8 million ounces that Deutsche Bank just bought might prevent them from bankruptcy. I'm joking, of course, but it is. I do find it.
Maybe silver go high enough to bail them out of their bad bank.
That's what I'm trying to say. We'll leave that alone. But the fact is what I'm saying. So you got 50 million ounces between two of the major ETFs. And then you've got Sprott, of course, back in there with a fair amount. But Deutsche Bank just cracks me up. There it is with a total of 35 million ounces, but they added, 8 million ounces the last month. There's about 30% additional amount of physical silver.
And I know there's a lot of speculation, particularly with SLV. We hear this about GLD2 of whether they're actually adding metal. I've gone through a couple articles in the past week of folks picking through the legal loopholes, which certainly I wouldn't hold metal in SLV on a long-term basis. I did go through the prospectus, and at least as I read it, again, I'm not a lawyer, but there was one clause where, whether it's legally binding or not, was clearly giving the impression that you can purchase new shares of SLV, but metal has to be deposited. Is that your take, or do you?
It's been a long time. I'll interrupt. It's been a long time since I went through it, letter by letter, and got any legal help on it. It's my understanding some years ago, I'm at my age, it's probably 3 or 4, that you could use a contract, as metal, at least temporarily. I don't know if that still holds or not. I try to be objective as I can. I mean, largely the metal is there. But as far as if it were to be liquidated and everyone that had a claim on it that's allowed to take it out, which is, just very few certain entities are allowed to actually capture that physical metal.
Right.
I would bet, a substantial amount that amount of silver would be oversubscribed.
Yep.
How much? I don't know. I don't think it's as bad as other places or other areas. But, at one time, because if you look at the perspective, again, it's been a long time since I read it and got legal help, but it tracks the silver price. And if you look at it like a lawyer would, Well, that's what's on the COMEX. It doesn't necessarily mean silver, the physical bullion itself. So you got to be a little bit careful. And this is done deliberately. But, for an institution, I mean, what are you going to do? I mean, I have friends that run hedge funds, and, I'd love to see them buy physical metal, but they're not about to do it. Why not? Because where they're going to store it, then they got to add that into the cost of their fund. And then they got to, and so they just are much happier to, hit the mouse, put it in their account, and hit the mouse, move it out of their account. And it's, and it's hard to say don't do it that way. I mean, for what they do, how they do it, and all that, makes sense, really. I mean, I'm not for it, but that's the way it is. It does make sense for them.
Yeah. So if we assume to some degree that metal is actually going in, again, I don't know which would be more bullish for silver, if 80 million ounces actually went into these funds, or if they were misrepresenting it, that would be a sign of who knows what else. But let's say that we can call this legitimate demand. I guess what I'm wondering is that I see these price spikes that we've seen for the last 8 years, which range, back in 2011, they were a couple bucks at a time. Even the last couple of years, when the banks get really short, you see it drop $1 or $1.50. Again, even this between last night and today, we saw silver down. It was about 20 cents, has rallied back. I'm wondering, have we seen in the same way that for years the offer was overwhelming the bid? It feels as if maybe now the bid is overwhelming the offer. And when you think about whether there's a big whale, whether it's JP Morgan, whoever's buying these ETF shares, could that be finally skewing that balance where the banks are trying to short? Because it's been interesting to me that they have been very short. And I don't remember the last time we saw the banks short and see the prices spiking like this. Could that be getting reversed because someone is out there buying a lot of silver?
Well, I'm going to go to gold, because gold I'm convinced of. Silver, I'm still watching it. But if you go to the gold market on the COT, I'm going to make up numbers, but my memory's pretty good, but they're not going to be exact. But you were somewhere in the open interest level of, I think it was 613,000 contracts. And that was about 3 weeks ago. And then you saw the next COT report, and it dropped 53,000 contracts, and the price was actually slightly higher. I can't remember seeing that, where you had that much of a massive short position by the commercials and then dropping that significantly in percentage terms, and the metal sitting there. So I'm pretty convinced that Bill Murphy is correct. In fact, I talked to Bill very recently. It looks like physical demand in the gold market has taken control. The problem I have with that is I've seen it happen a couple times in this last bull market and I'm going from 2000 till now, so last 20 years. And whenever that demand is accomplished, satisfied, delivery made, however you want to term it, then the paper markets, come back and take over control again. So let's, for hypothetical purposes, say that there's X entity out there that demands a certain amount of gold that's very hard to obtain. So the price gets bid up to, $1,612 or whatever. And at that point, somebody lets loose of enough physical to satisfy this entity, and they get their gold. It's locked away. It's bailed in. Bailment is a term for, taking physical gold. You can look it up. But anyway, the bailment process takes place and they're satisfied. So now what are they going to do? Well, they're done, or at least done temporarily. I'm saying this is all hypothetical. So then if that's accomplished, then we see the markets come back into this, big sell-off, profit taking, whatever you want to call it. This big correction takes place. And all of a sudden the trading resembles something similar to what we've seen for years and years and years, where you see these small up and down moves in the gold market, and they're basically contained. So is that going to take place, Mr. Morgan? And the answer is, I don't know. I've seen it happen before. I really, of course, anyone that knows me knows I'm rooting for the physical market to take control from here on out. I think that's what we all want to see. Right. But just because that's what we want doesn't necessarily mean that's what we're going to get. And so I want people to be a bit cautious that we could see, as I just described, this physical demand that's basically driving the market right now does get satisfied. And once that happens, chances are we're going to come back into, what we've already known for years and years and years, and that is price management. On the silver side, I don't think it exists yet. It could. And what's so funny about the silver market, not funny ha-ha, is it's such a small market. I mean, basically, if someone, let's say on the gold side, is doing what I just described and says, you know what, I know how I'm going to, really get this manipulation taken care of. I'm going to go with this, here's my dollar stack over here for the gold market. Oh, and here's my pocket change for the silver market. I'm going to take this, dump in the silver market, do the same thing I'm doing in the gold market. Now they've really got a problem, because with a few more bucks, it's like putting a dessert on the end of a big meal. It's really not much. They already got an extremely expensive dinner with wine or whatever. Now it's just, one little added thing. Oh yeah, I'll take a slice of whatever for dessert. They throw that on there, but they go back into the restaurant that doesn't exist. They got to go over and get it from the next restaurant and bring it to you. So I hope I'm making a good metaphor. The point being is that that's really how I would do it. I would just get the gold market cranking, and then once it looks like they're going to satisfy me, they finally scrape the gold together. Say, oh, by the way, I just want to add this little bit of silver. There's no problem with me getting 1 billion ounces of it, is there? And I'm making up a number. Obviously, billion's a big number in ounces. I mean, it's like half the silver supply. But in terms of paper money, it's absolutely nothing. It's that dessert metaphor I'm using. So I don't know, Chris. For that to happen, I'd have to see silver in the 18, 19, 20 range pretty quickly. Volume goes up quite substantially, and short covering up the kazoo. And if all those three took place, I'd say, oh my, here we go. So we're not there. I suspect the way we're trading right now that we're probably going to get some profit taking, and all that I said is conjecture. I mean, I'm not saying this is absolutely, but it certainly is trading. I mean, and I've watched this market almost daily for decades. that the physical market is on the gold side is taking control.
Yeah, some interesting things you mentioned in there, and certainly to the degree that people look to gold first and then move into silver, we've been seeing that over the last month, where maybe if you call the rally for both of them 2 months long, a lot of the talk has been centered on gold, although it's like last night I heard a video from Jeff Berwick, who talks a lot about gold and cryptos, and now he's saying, hey, look at silver. And you hear even more in the mainstream where, certainly one of the things I look at as I'm trading this is often there's been several times you see gold up a bit, silver's lagging, and certainly like you point out at the 90-to-1 ratio or wherever it's at today, a lot of catching up to do. Another thing you mentioned in there about the short covering that I found interesting in last Friday's COT report, where it looked like on higher prices, the bank commercial short position actually was reduced, which is pretty unusual for what we've seen. Have you seen that before? And would that imply that perhaps one of these banks is getting a little concerned and reducing and trying to exit their short?
Yeah, well, this is from 30 July, so this one isn't the one we want. Let's see, what's this one? Yeah, same one, or is it? Oh, yeah, it is. Anyway, no, that's something they don't see often. Yeah, but they cover that much short on the commercial side. That's pretty eye-opening. And again, it just goes back to what I'm saying. And everyone's saying, well, it's a trade war and it's geopolitical uncertainty. Look, those are the fundamental facts that we've had for the last 6 years.
Right.
All the reasons they're giving for gold's move is like a fundamental reason, and that's just continued from the time that gold was made it to 1050 print. It's still, you want to own gold. I mean, I don't mind throwing out other names, but I mean, look, Jim Sinclair, or Jim Rickards, or Bill Murphy, or I don't know who, but almost all these people will tell you that you should have a gold position. They'll tell you your life saving goes into gold or any of this stuff, and that's all based on fundamentals. But the reason that we're getting this big move now is because, these fundamental factors, BS. The reason we're getting these big moves in gold is someone's got control of the gold market. And
Right.
it's not the bullion banks presently. That's what no one's saying, other than I think myself and Bill Murphy, maybe a few other people. I can't read everybody on the net. I mean, just to digress a bit, Chris, but you've known me a fairly long time for my work. We haven't met each other until a few years ago. But, I mean, it was like, Franklin Sanders, Ted Butler, and myself were about the only silver bulls back in 1998 or whatever. So, but now, and it's fine. I mean, I have nothing against it, but, I got guys, Scheckman that came in and out, the Andy variety, not Scheckman, but Hoffman. I'm sorry, Andy Hoffman, and Bixweir, and on and on and on. And that's fine, But point being, we've watched this for a long time. I'm convinced of what I'm saying, believe it or not.
Yeah, it's something that we just haven't seen before, and we'll make this a two-parter here. First part is that last Thursday, I believe, was the first time I read about how, as the prices are going up, at some level, do these banks, because they've been short a lot of gold and silver, do they get a margin call?
Well, they have infinite cash, as we know, and they can print it or whatever. Plus, they get the fact that they're commercial, so they have to put up 30% less money than you do if you're just a speculator or a managed money account. And, Gata made a big thing of that. I mean, that's been that way forever in all the commodities. But regardless, so they get a break. Is it? Yeah, in theory, they could. What really happens, Chris, is when it really gets going and it gets out of their control, they basically let it go.
Right.
The best example is if you're familiar with the silver market, then you have to go back to the 2011 timeframe and the last, month or so of trading, where silver, went from, last few months of trade, but, went from basically 19 all the way to 48. But if you look at the chart and went parabolic, I forget when exactly, but it'd be just a few weeks. So what they do is they basically don't, do that much and let it run until the buying power subsides, because there's only so many silver bulls out there in the world, and it represents 0.02% of the financial system. Not very much, not 1%, not even 0.1%, not even 0.0, it's 0.02%, which I have to digress, just astounds me when you think that, I was 11 years old and we're still circulating silver coins in the US. But coming back on point, there isn't a lot of interest in the silver market, which is good and bad. It's good because, just think of a doubling. 0.04% of the world's population wants silver now that, gold's past, pick a number. Once gold gets past 2,500, 3,000, I don't know. But as gold moves, it'll draw silver. Then all of a sudden, everyone's going to come in and they'll learn everything about silver in, 2 videos, that there's less of it above ground and that it has the industrial uses and that, on and on and on. All of a sudden, there's an instant silver bull and he calls up, so-and-so to buy silver. And the problem that the authorities have is that, you can buy silver. I said how difficult it is to buy silver outside of the North America, and that is true. But it's also true that it's it's easier than ever as far as if you're in North America, and even if you're in another jurisdiction, depending on which one you're in, to buy silver over the internet. So even if you're in a kind of a crummy jurisdiction, like let's say somewhere in Asia, there's nothing to prevent you with someone that deals with the Asian market to use that mouse click and, buy silver, or at least get a stake in the silver market, maybe with the SLV or whatever. So
right.
A lot to look forward to as far as when this market breaks. The only caveat I guess I have to say is that as much as we'd all like to see $100 silver or 200 or 500, wherever it's going to go, and I'll say it's going to any of those levels. Well, I have said 100, so I have to keep my reputation. And I think it will definitely still get to that level at least. But is what does the world look like when you've got $100 silver? And the answer to that is a lot different, I think. I think once the metals run free, there's going to be so many reasons why they're running free. And it's going to have a lot to do with this bubble that we're in, with this debt bubble, and why the equities are so overvalued. And they're going to start to move in the direction of down to really give a fair value to what they're really worth. And then, of course, the bond market is going to basically go along with it, because, you know, if the dollar isn't trusted today, why would a dollar that's a year old in the bond market, or 10 years old in the note market, or 30 years old in the long bond, why are you going to trust that? If you're not trusting the dollar today, you're going to trust one that's a year out, or 2 years out, or 5 years out, or 10 years out? No. So when the collapse, quote unquote collapse, doesn't mean it goes to absolute zero, but when the fun run begins, and I mean, it will be a fun run for precious metals investors. When that fun run begins, look out, because paper price on the metals might become immaterial. It's possible. I'm not saying it's inevitable, but it's possible. So you might have to value your precious metals in terms of real estate, or in terms of the Dow, or in terms of automobiles, or in terms of wheat or something. I'm not saying that's going to happen, but it could. It's very, very interesting times. And no one's really, I mean, I'm not really rooting for this. I mean, I've seen it since I was a kid, basically, and I've overstudied it, and I've been wrong in the past as far as when was it going to happen. Honestly thought it would happen before this point in my life, but it hasn't. I mean, it got close in 2008, very close, but close isn't it. And so this is a situation, because when that does take place, then you're going to see a new, you know, Bretton Woods type of situation, where the monetary authorities get together and come up with a new, you know, monetary system or whatever. And if they don't, that'd really be interesting. But so that's what we're facing. I really am convinced that that part of the equation is inevitable, but no, when, David, and I'm kind of tired of saying when, because I've never known. No one's ever really known. We've, again, gotten close a few times. I wish it happened in different countries. I mean, if you're talking about, well, no, you know, you're wrong. Well, no, it's happened again and again and again. In Argentina, it happens about every 10 years. You know, it's happened in many of the countries right now. If you look at Venezuela. But the problem is, you know, we're so US dollar centric, because it's the reserve currency, that since it hasn't happened to the dollar, it never happens. Well, it does happen. It just hasn't happened yet to the degree that people understand it. And I have to digress a bit more, Chris, and thanks for letting me go. But, you know, if you looked at the US dollar from 1913 till now, it's worth about 2 cents. Mm-hmm. So it has happened. It's just happened in such a slow time frame that no one really admits it. But if you shrunk that, you know, 100-year plus time frame down to 10 years, and it went from 100 cents to 2 cents in a 10-year time frame, then everybody'd be aware of it.
Yeah. Well, I think people are becoming aware, and you know, you raised some really good points there, because perhaps you can look at gold and silver as a proxy of an inverse proxy of the dollar. And going back to 2011 for a second, again, that was following QE2, where Ben Bernanke, you know, took the world's reserve currency and just exploded it. Again, you had the debt ceiling debacle, where someone actually noticed that every time we hit the debt ceiling, it just gets raised higher. Now they don't care anymore. Yet I saw what was happening in 2011. I wonder if perhaps we were close to seeing some real revaluation of the dollar. And perhaps it was just when you had a big block offer in the middle of the night at the end of April in silver. And then again, later that year in gold in September, you have gold cross through $1,900. The Swiss come out in the middle of the night, say they're going to peg to the euro. So the franc, which had been supposedly the last safe haven, aside from gold, and yet you see gold get smoked in the middle of the night. So I get it, you know, and certainly I didn't realize then perhaps the political pressure behind this issue. Yet, to what you were saying, I think it is an inevitability. You know, maybe that's next month, maybe it's 50 years from now, and we're still way too early. Yet, why it's so fascinating to me right now is when you think about these dynamics, again, we're still figuring out what's going on. Yet, if the banks are not able to drive the price lower when they write additional short contracts, if you already are short something that I mean, I got to figure these guys know that it's worth more than, 15 or 16 bucks at the cost of production. If you do reach the point where you can't drive the price lower when you short, then essentially there's no reason to short. And also, as the price goes higher, whether there are significant margin calls, I know some feel that played a role in Bear's failure. As the price goes higher, you bring more mainstream investors in. So it seems like a degree to which the longer it goes without getting smashed, the more difficult it becomes to manage because you are in a really small and tight market. Would you?
Yeah, I'd love to comment on that. Yeah. Oh, yes and no. The situation is that the over-the-counter derivatives market is far superior in size to what the COMEX is. I mean, everyone focuses on the COT, and it's a good tool, and it does set the paper price of gold and silver, and the paper price equals the physical price of gold and silver most of the time. It didn't equal it in, the 2008 debacle for retail silver product, but you could still buy commercial bars for the paper price. So the point I'm making is that the way that these bigger entities or even a big trader will take care of business is they will lock in their loss and live with it. So we don't know what some of these shorts are doing on the OTC market. They may be long just to make sure that once silver goes silver goes above 18, that's it, and here's their loss, and they can manage it right off their books, put it on off account methods, all these things that they do these days, where it's very difficult unless you read every footnote on there to determine what the heck happened to all this money they lost. But that's the situation. So I suspect that with what's going on in gold, especially looking at the COTs we discussed a few moments ago, that some of these traders that are hurting badly with the gold continuing to make these new highs have basically taken measures to make sure that they don't get hurt any more than they are. And as you said, the fun part is that it's like, well, if they could short the heck out of it and it doesn't work, then what do you do? Well, you go long, as I just said, in a different market, but still the question remains, how are you going to get the price down? And the answer is profit taking. At some point, these funds, these money managed accounts that don't have unlimited capital like the banks, see that they got in at, let's say, for example, 1350 to 1400, and now we're at 1550 as an example. It's like, you know what? We want to book some of these profits. So once that takes place and they start booking profits, what will these guys do that are on the other side? Well, the commercials will then say, oh, if they're selling, we're selling on top of them. And so now there's a bunch of sales and no bids. And so now the price will come down. That's what happens every single time. And that will happen again, in my view. It's just how far down will it go? And that remains to be determined.
Yeah, it's it's going to be darn interesting to watch. And perhaps if nothing else, it's been nice. It's the most excited and fun it's been thinking and watching what's going on in a couple of years. It's certainly interesting dynamics. And perhaps just one last one to get your comment on before we wrap up. If you had all this happening and the Fed was, I won't say raising rates and quantitative tightening, since that, in my opinion, never really happened. I'd say selling the impression that they were raising rates and doing quantitative tightening, then maybe you'd have some conflicting factors, although basically the last couple of days have been thinking over everything we've just discussed. But then add on that, you have the Fed did their first rate cut. Looks like markets expecting 50 basis points a month later in September. We're seeing central banks around the globe cut. And then it occurred to me, I mean, if somebody offers me a bet on an ounce of silver, whether QE happens before the end of the year or not, I'd say we're probably going to see it. On an even money bet, I'd say it happens before Christmas rather than after. So I'm curious how you see it. It's like, geez, if we get QE this year, I wonder if that's maybe just the knockout punch where, it just becomes so obvious that you can't sweep it under the rug anymore.
Yeah, wow, what a great question. Let me take the last slurp of coffee here. Look, in 2011, or maybe it was 2010, but I think it was 2011, QE2 was announced. And silver went from 19 to $50. And why is that? Well, most silver bugs know what Professor Roy S. Jastrow wrote in Silver, the Restless Metal. There is nothing, absolutely nothing, and I mean nothing on the planet that does what silver does in an inflationary environment. And everyone, including yours truly, thought that QE2 was going to go to Main Street, not just the banks. And all of us were wrong, and maybe everyone knew that except me, but it only went to liquefy the balance sheets of the banks. It never got into Main Street. But the suspicion was, and the proof is in the market. I mean, the market took off like, you know what, and almost straight up. Lots of volume, and they had to change the margin requirements like 4 times or 5 times to get the market to cool off. Anyway, so I said all that because I want to say that, yes, this time I think it would be different. This time when they do the QE, not necessarily that it even hits Main Street. It doesn't really have to, I think, at this juncture, because it's been, you know, what, 11 to 19, it's been 8 years, 9 years, where we know, we, meaning those that are awake and understand how the system works and how manipulative it is, and how all currencies are destroyed in the end, how the end of the age of empire is upon us, and how everything that we know to be true is showing us in spades. I mean, the constant lying from the fake stream news, the, you know, GMO foods, the, you know, air we breathe, the water we drink, the educational system. I mean, I could go on and sound like a cranky old man and be absolutely truthful about everything I'm saying. So I think this time when they do QE, it doesn't absolutely have to hit Main Street. It might, but it's going to be enough. So the last time it took place, I think in 2011, when we went from 19 to 50, was a precursor to what will happen the next time. So I'm in agreement with you. Whether it happens or not remains to be determined. But there is that point, that tipping point, that point of no return, that fun run I refer to, where all of a sudden the psychology changes, and, you know, guys that are kind of like paying attention to, you know, Ted or Jim or me or James Turk or whomever, doesn't really matter, because it's not the messenger, it's the message. The message is these things fail, they fail badly. And you want to be ahead of the curve, not behind it. Because once you're behind the curve, you might have the best airplane out there and firewall it, but you've gone too far, you stalled out, and you're not going to get anything. As Greg Hunter says, there'll be a point where either you have it or you don't. I think that could be the case. Would be the case, I don't know, but could be the case, absolutely.
Well, David, I sure appreciate you joining me here today. And perhaps the best news of all of this is that, folks, if you're watching and listening at home, David has a newsletter that you can get access to where he covers everything that's going on. Incredible information you share, incredible body of knowledge and history that you have to draw from. And again, as simply as I can put it, the primary reason I walked away from Wall Street was I saw how glaring this was and how out of line it is. And I just say that as having a trading background, it was worth the magnitude of what I think is going to happen. The timing remains unknown, but certainly fascinating things happening now. And perhaps you can just let folks know how they can find you and learn more about the Morgan Report.
Yeah, if you'd allow me to digress one more time here. So when I started, it was, you know, solo effort, just, you know, me, and then it was me and my webmaster. And then, you know, I've got 2 guys working with me now, and, you know, I got a small staff. But early on, I hired a gentleman from Russia, Sean Rakimov, and Sean came from Wall Street. And I'm saying this because of what you just mentioned. And Sean came and asked if he could, you know, give him a try or whatever, which I did. And he did work with me for a few years. But he said, you know, I'm right on Wall Street. These guys know absolutely nothing about what's going on.
Absolutely true.
And
True.
And I digress a little bit, because he had two accounts. He had an account for his wife that was the TMR, the Morgan Report picks. And then he had his own account, because he moved to Vancouver. He left New York, moved to Vancouver, became a Canadian citizen. And he was right there in the mix, man. Every little hot company that ever begins in Vancouver. I mean, once in a while there's one, but 99% of them are out of it. So he had the inside track. He's there. He's talking with these guys every day, having coffee with them, and chitter chatter. So he does all this. This is when the market was a pretty hot market. It wasn't the hottest, but it was cooling off, but still a bull market. And the Morgan report beat the crap out of the returns of the, hot tip market.
Right.
And I just said that, one, it's a fact, and two, people got to know once you get outside of the physical realm, which is, all you really need to do, to be careful. Everyone loves these story stocks about this, 3-cent stock went to $30, but folks, it's a rare event. You're much better off. In fact, I just looked at our top tier asset allocation table, and every stock in there is up, 100% to 3, 4, 5, 6, 700. I think one's even at 800%, except one. I have one loser in that whole thing, and that's money, big money. That's solid balance sheets, great management, billion-dollar companies that you can write call options on and get 17% a year conservatively, just because they have such high betas. And but these are the kind of stocks that but very few of the gold newsletter business ever talk about. All they ever talk about are these story stocks, which sound great but lose you money most of the time. So thanks for letting me spout that off. Best thing to do, go to themorganreport.com, get on our free list. You get interviews like this for free. I do a weekly perspective every week to try to summarize what's the major points of the financial markets. Usually have a comment or two on the gold and silver markets at the end of that weekly perspective. Show you all the webinars I'm doing for free, show you my speaking schedule for free, give you offers on books or whatever from time to time, and dealers that we work with, and you know who I'm referring to. And it's not just them, it's some others. If they have a good deal, I'll put it out to that list occasionally. And then, of course, we always want our new members. But the Morgan Report isn't for a beginner that's never had an equity account. I mean, you really should have traded stocks for a few years, really know some of the financial terms. We never try to talk over anyone's head. We try to make it very clear and concise. But nonetheless, it's a very volatile market with extreme betas on these stocks, which means they move up and down rapidly. And it's part of your positions. I mean, if you're a stock investor, you shouldn't use the Morgan Report to be like your sole source of what stocks you own. It should be your hedge position. So you've got 80% in, legacy stocks that you love or whatever, and then you could supplement it with maybe 10% out of our list, with most of them coming from the top tier, some from the mid tier, and then speculate. Yeah, I have to. I couldn't be out of business if I didn't have any speculations, but I've got more companies that became mines than anybody else in the industry. How the heck does that happen, right?
Yep. Well, it happens from all the research and effort and knowledge that you poured into this sector, and it's really great that there's a resource like you out there. And again, thank you for joining me on the show today. Wild things happening. It'll be interesting to see how it unfolds, but great comments, and we'll look forward to doing this again soon.
Well, my pleasure, Chris. Thanks for having me.